and welcome to the Accounting Telematics session. Today will be the second part of analysis and interpretation, the one that we had last term. What we did, we went all over the analysis and the financial indicators that we had to do. Then we did activity number 5 in the workbook. So today, what we're going to do, we're going to go to the workbook. We're going to continue, hopefully, with activity number 3, as well as activity number 4. Okay. So learners, let's go to your workbook, activity number 3, and the answer book. Righto. What's the information that they are saying? First of all, they're saying it's a public company, Material Supermarkets Limited. It's a public company. The financial year end is the 28th of February 2014. They want us to calculate the financial indicators. So when we talk about financial indicators, they are referring to the ratios that we have to calculate. Okay? There they have the net asset value, they have the debt equity, and they have the percentage return on average capital employed. Now, the previous session, we spoke about all these ratios and how important it is for you to memorize the formula, and then you have to apply them. Okay? For example, if we talk about net assets, if we know the accounting equation, it's going to be assets equals owner's equity plus liabilities. So when we talk about net assets, it means the assets minus the liabilities, and that will give me the owner's equity. So whenever you see the word net assets, then you must know we're talking about the owner's equity. Okay? We'll come back to the other two as we go along now. We'll just go and fill in those items, and then we can see how it works. Okay? So first of all, we'll just look at the information. At the bottom of the page, they're giving us information that's an extract from the income statement. They're giving me the interest on the loan or the interest expense. They're giving me the net profit before tax. They're giving me the income tax. But many of the ratios normally require for us to use the net profit after tax. So they're not giving the net profit after tax, so we can just go and calculate the net profit after tax quickly. Okay, so it's going to be 1575 minus 441, and that gives me 1134,000. Okay, so just in case we have to use a formula where they ask and it requires us to use the net profit after tax, then I already calculated the net profit after tax. Okay. Then also if you look at the other information that they give us, they're giving us a set of the extract of a balance sheet. The previous year was 2013 and the current year is 2014. Okay? So this is, we'll probably get most of those figures from the balance sheet. And the current liabilities, the non-current liability, which is the mortgage loan. So we'll just abbreviate there quickly. Non-current liability. Shareholders' equity, also called owner's equity. Okay? As you can see, there's no fixed asset note over there. So it's not a complete balance sheet. That's why they say it's an extract of the balance sheet. Okay? Then also, they're talking about a share register, saying that we had 1,200 shares at the beginning of the year. Then on the 31st of March, we've issued an extra 300,000. So after the 31st of March, we have 1,500,000 shares. Okay? So the 1.2 million plus the 300,000 gives me the 1.5 million. And then on the 31st of December, we bought back 50. So we have to repurchase 50,000. But remember, if we're buying back or repurchasing, we're decreasing the number of shares in circulation. That's why we have 1,450,000 at the end of the year. Okay, then the last bit of information they're giving us is some of the financial indicators, or also just called the ratios. Right, for the 2013 and the 2014. Most probably there where the question marks indicators, those are the ones that we have to go and calculate. Then we can fill them in and then later we can comment upon those items. Okay. So let's go straight away to the answer sheet. Right, it says calculate the net asset value per share. So what do we need? We need the net asset value, and as earlier, remember I said net asset value is owner's equity. So we're going to look at that part. So we're looking at that figure for the owner's equity, which is 8,839,000. Okay. So let's write down the formula first. Right. It's going to be ordinary shareholders' equity over the number of shares in issue. And then we have to multiply with 100 because we want the answer in cents. Right, so the ordinary shareholders' equity, 8,839,000. The number of shares, 1,450,000. So we write them just like that. So it's 8,839,000 over 1,450,000. Multiply with 100, and then we calculate. Okay, simple, straightforward calculation. Just remember that your answer has to be in cents per share. So this gives me the actual value of the shares. Okay. So based on this, we can see whether the shareholders would be satisfied or not. Also, whether the directors are undervaluing or overvaluing the shares, depending how the shares is being sold on the Johannesburg Stock Exchange, which will give us normally the market value. Okay, so whenever we talk about market value or the actual value, you must please compare the market value with the net asset value to determine whether it's the shares, whether we're getting a good price for the shares that we're buying back or whether we're issuing new shares and stuff like that. Okay, if we calculate this quickly, we'll get to an answer of 610 cents per share. But because you're multiplying with 100, we have to write in cents. You can also write the answer as 6 rand 10 cents per share. But then you just have to remember, there have to be or, but then you can't put 610 and then write cents behind that as well. It's either 610 cents or just 6 rand 10 cents. Okay. It's very straightforward, very easy formula to remember. Grade 12s, let's make sure we know how to do this, we know how the substitution goes, and we get to the correct answer for the September exams as well as for the finals. Okay. The second part, the second question, it says calculate the debt equity. Right. Now normally debt equity, there we see the word equity, so we have to refer to ordinary shareholders' equity. And debt, that's the money that the company owes. Okay. The money that the company owes will be in the form of a loan, right, or a non-current liability. A mortgage loan is an example of a non-current liability. Then also they're giving us the interest percentage over there, the 12.5%. Okay, so if we know the formula, just remember that the 12.5% we'll take into consideration later, just in case we have to do some commenting on the loan and stuff like that. Okay, so the formula there, simple, it's non-current liabilities is to ordinary shareholders' equity. Okay, so in the ratio, you're going to express it as something is to 1. So the item on the right hand side, that will always equate to 1. That means both sides you'll have to divide by the amount on the right hand side. Okay, so we go look for the amounts for this particular ratio. Right, there we see it. That's the non-current liability, right? And in the equity, that's the non-current liability, and that's the equity. So those are the two figures that we have to express in the form of a ratio. So it will be 908,000. 908,000 is to 8,839,000. Okay. Remember I said now that we want 1 on the right hand side. That means whatever figure we have on the right hand side will have to be divided by itself. So it's going to be 8839,000 divided by 8839,000, and that gives me the 1. Therefore this side will also be 908,000 divided by the 8839,000. So when we do that on the calculator, just the 908,000 divided by 8839,000. Right. The answer is 0,102. Then we round it off. We say 0,1 is to 1. Okay. What does this mean? It means that because the owner's equity refers to own capital and the non-current liabilities is foreign capital, that's the money that we're going to borrow by the bank, right? Can we see that we are using more our own capital compared to the foreign capital? So whenever we talk about the debt equity here, then we say now it's going to be low financial risk, meaning that it's actually favorable to go and borrow, because we only, as you can see, it's about a tenth. Our foreign capital is only a tenth of our own capital, so it's favorable conditions to go and borrow money. Okay. It's a low financial risk, so it's favorable to go and borrow money. Right. Also, very important that you know this ratio, grade 12s. Favorite one that they normally ask at the end of the year. If they don't ask the ratio, they normally ask you how to comment on that particular ratio. Okay. Let's move on to the third question. Right. They ask you, calculate the percentage return on the average, when you see the word average, capital employed. Okay. Any return refers to the net profit. So we have to look at our net profit. And when we see the word average, then in your financial indicator, you have to indicate a half or 0,5. Okay. So that ratio is normally the net profit before tax. Right? Net profit before tax plus the interest on your loan divided by average capital employed. Okay, so what is capital employed? What is that part? Okay. Capital employed refers to your own capital and your foreign capital. Okay. So capital employed refers to your own capital and it also refers to your foreign capital. Then we're back at the previous ratio because the owner's equity is our own capital and the non-current liabilities is our foreign capital. Okay, let me repeat that. The owner's equity is our own capital and the non-current liabilities, that is our foreign capital. Right? So when we do the return on capital employed, we're looking for own capital and we're looking for foreign capital, but they're saying it's the average, so you should have the average of year 1 and year 2. Okay? Average of year 1 and year 2. Right, so what do we have on top? It says the net profit before tax plus the interest on the loan. So when we look at the information, here we go. It's net profit before tax and also the interest on loan, which is 88,500. So those two items or those two amounts, those are the figures that will appear on top in the financial indicator. Okay. So it's going to be net profit before tax, which is 1,575,000 plus 88,500. It's on top. at the bottom. The word average tells me I must have a half. So what is it half of what? Half of your own capital for the 2 years and half of the foreign capital for the 2 years. Okay, so if we look at the information, we will find that. Right, so shareholders' equity, that's the own capital. Non-current liabilities or the mortgage loan, that is the foreign capital. So I'm looking at 4 figures. So it's the average of that two and the average of those two. So it's going to be 7.4 million, then the 8,839,000, 508,000, 908,000. Just be careful because they're giving us the totals already. If those totals weren't given, then there could be a possibility of 6 figures at the bottom, because the owner's equity consists of the capital and the retained income. But in this case, they gave us the shareholders' equity, which is the 740. So I take 6.6 million plus the 800,000, I will get the 7.4 million. So we don't have to write those figures, we can just take the figure of 7.4 million. And in the same with the 2014, I don't have to write the 87 or the 139, can just write the 8,839,000. Okay, so let's get to the financial indicator. So it's going to be 8,839,000 plus 7,400,000 plus 508,000 plus 908,000. You close the bracket and you multiply with 100 because you want the answer to be in percent. Okay, so if we do that on the calculator, right, so it's going to be so it's 1,575,000 plus 88,500 divided by half of the bracket, 8,839,000 plus 508,000 plus 908,000. Close your bracket and you multiply with 100. You should get 18.84%. Right, so if we're rounding him off, we can just call it 18.8%. So we always write the original answer first, and then if they want 1 decimal, then we just give them the 1 decimal. Just remember, if that was a 5, it could have gone to 18.9. So when we get the percentage for the return, normally we call this ratio return on total capital employed. When we get the percentage of 18.8, we're always going to compare with the interest rate. Okay, so in this case, the interest rate that they gave us in the information, because we are borrowing money from the bank, we will have to pay the bank 12.5% interest per annum. Okay, so we will always compare the return that we're getting to the 12.5%. So what's happening that the return on total capital employed, the return that we're getting because we're using the bank's money, is greater than the interest that we have to pay the bank. So again, the conditions are favorable. Okay, so it's a low financial risk and we lowly geared. Okay, it's favorable because our return is greater than the part that we have to pay back the bank. Okay, and on top also, grade 12, very important that the debt equity and the return on total capital employed, these two ratios, they go together. Whenever they speak about loans, you can see there's the loan in, right? And you can see here at the bottom, there's the loans. Okay, whenever they speak about loans, you have to refer to debt equity and you have to refer to return on total capital employed. Okay? These two ratios are very important for you, especially with your comment, and you must know how to substitute and you know how to get them, please. Okay? I'm sure that should be easy. Right. Then, what do they want now? By 3.2, it says comment on the liquidity. Right. It says comment on the liquidity. So if you're looking at liquidity, we're looking at short-term obligations. In other words, whatever we owe that is payable within a year. Short-term obligations, it's payable within a year. Okay. So whenever they speak about liquidity, it's always the ability of the company to settle its short-term obligations. Okay. All those items that must be paid back within a year. Right? So they say comment on the liquidity position of the company, quote 3 financial indicators. Normally with liquidity there are 6. They only want us to extract 3 from the information that they give us. Okay? But there are 6 liquidity ratios. Okay? So what do? We just have to look for those items in the information, find them, and then we have to comment. Okay? There they give us debt equity. That was the ratio that has to do with loans. The net asset value, that has got to do with the net asset value or the current value of the asset. The current ratio, here we go. That's one of the liquidities. Okay. So I have the figures for the 2 years, and I can just comment. Then the asset test ratio, that's also a liquidity ratio. Yes, stock turnover rate, that's also a liquidity ratio. And the last one in this information, that's the debtors collection. That's also a liquidity. Okay. So what's the other 2? Normally it's the one that's got to do with stock. So that's the stock turnover. So it's the number of days stock on hand. And this debtors collection. So the other one has to be creditors payment. And that's the 6. These are the 2 that you're not going to use because it's not given in the information. They only ask you for 3, so we have to quote any of those 3 of the 4 possibilities. Okay, so we only have to select 3 of them. We don't have to comment on 4. But now it's straightforward. So now all you have to do, we have to mention the ratio, look at the trend, and supply the figure. Okay, for example, I'm not going to comment and say it when I refer to the current ratio. I'm going to mention the ratio. I'm going to say current ratio. I'm going to look at the trend. Last year it was 3,6:1. This year it's 1,6:1. So the trend, it decreased, right? So I can look at it there. I can see there was a decrease. The same with the asset test ratio. I'm going to mention the asset test ratio. I'm going to look at the trend. It was 3,1. It's 1,2. It's also a decrease. What happened to the stock turnover? It was 5,1. It increased to 6,8. So that's the increase. Then the debtors collection. Last year it was 35 days, meaning that the debtors took 35 days to settle their accounts. It increased this year to 40 days. So it's an increase which is not good because now the debtors are taking longer to pay. Okay? So let's see, what do they want? Right, so they want you to mention the financial indicator, and they want to give the trend, and also it says you must supply actual figures and percentages. So when we do the first one, we're going to mention the financial indicator, meaning we're going to talk about the current ratio. right? The trend, that refers to the increase or the decrease. Okay. So what happened to the current ratio? Earlier we said it decreased, so its current ratio decreased from 3,6:1, that was the ratio in 2013, to 1,6:1 in 2014. Okay, so it's simple, straightforward. Just have to get the information from the information given. It's the current ratio, it's liquidity. It was 3,6:1. It's now 1,6:1. So my trend is right. Current ratio decrease, right? Here we go. From 3,6:1 to 1,6:1. Then I have to do the same with the second financial indicator and the same with the third financial indicator. Okay. Right, I see there's a question here quickly. Talks about NCL, right? Just take that quickly. Okay, NCL was just non-current liabilities, right? Which refers to the mortgage loan. Okay, so it was just NCL, non-current liabilities, which refers to the mortgage loan. Just get back to this liquidity thingy again. Second financial indicator, we said we're going to take the asset test ratio. So we talk about the asset test ratio. What happened to that? The trend, remember, it's either an increase or a decrease. So the asset test ratio decreased from 3,1:1, that was in 2013, to 1,2:1 in 2014. Okay, so again, mention the financial indicator, the trend, increase or decrease, and then you supply the figures. Okay, the same with the third financial indicator. Just remember, they're asking for 3, so we can decide which one we're going to use. Okay, so it's a toss-up between the stock turnover and the debtors collection. Okay, I will do the debtors collection. Say debtors collection. Debtors collection period, meaning the number of days that the debtors take to settle the debts, right, increased from 35 days in 2013 to 40 days in 2014. Okay. If you wanted to, you could have also mentioned the fourth ratio, but clearly they only ask for 3, so you can choose any 3 of the 4 that is given. Just make sure here, grade 12s, that you know which ratios refer to liquidity. In this case, it was the asset test ratio, the current ratio, the stock turnover, and the debtors collection. You must make so to any of those. Clearly, if you're going to mention the debt equity net asset value or the return, it's going to be incorrect. Okay, so you must make sure that you know which ratios refers to liquidity. As I said earlier, there are 6. They're only giving you 4 in the information, so you must only use 3 of that to answer question 3.2, right? Then they ask you for a general comment. Remember earlier when I started, I said when we're referring to liquidity, we're talking about the short-term obligations. There's a decrease in all of the ratios, right? The only increase is in the debtors collection, but that's actually a bad thing because the debtors is taking longer to pay, right? So you can say the debtors are taking longer to pay. and there's a decrease in the ratios, right? The current ratio decrease and the asset test ratio. Okay. But although a decrease, the business will still not struggle to meet its short-term obligations. Okay? Although a decrease, the business won't struggle to meet. Although this trend here, this must be rectified. You must encourage debtors normally to pay their account after 30 days. Debtors are supposed to pay their account after 30 days. Okay? So that's a negative trend. Okay? So you must make sure. So there's a decrease. So the ability to settle the short-term debt or short-term obligations will be affected. Okay. How? Negatively. Okay. Why? Because there's a decrease in the ratios. So that has to be rectified. Okay. This ratio is still acceptable, right? That ratio is also still acceptable. Okay? But as soon as we talk about liquidity, you must remember grade 12's liquidity, it's short-term debt. Or short-term obligations. Okay? The ability to settle the short-term debt or the short-term obligations. Normally the comment or some of the calculations, like in this example that you had to calculate, normally that's a favorite for the end of the year exams. But please make sure that you know how to do it. It's going to be helpful for you in the future, so you need to understand how to quote and also how to get the figures from the information. Okay, then the last part for this over here. Okay. Right, they're saying on top, the directors decided to increase the loan during the current financial year. Quote 2 financial indicators. Okay, so they want financial indicators with the figures that are relevant to their decision, then explain whether this was a good idea or not. Okay, so what we have to look out for, we have to see, okay, that they want to increase the loan, which means they're going to borrow more money. Okay, they're going to go and borrow more. So we must check at was the conditions to borrow favorable. That's what we need to look at. Okay. If the conditions to borrow is favorable, then it was obviously a good idea for us to go and borrow money. If the conditions was unfavorable, then it was actually a bad idea. Right, so earlier we did 2 ratios that was regarding that affected the loans. Right, so normally the 2 financial indicators. Right, it's going to be debt equity. Write that differently. It's going to be debt equity, and the other ratio is going to be return on total capital employed. Remember, debt equity, non-current liabilities, is to owner's equity, and this one we have to compare to the current interest rate of 12.5%. Okay, so if you know what the ratios that we have to look for, it says a nice paragraph, but they only want us to look for 2 financial indicators, which refers to the debt equity and the return on total capital employed. So in one space you're going to talk about the debt equity, in the second space you're going to talk about the return on total capital employed, and then we're going to give a general explanation on those 2 ratios, whether the conditions to actually go and borrow money was favorable or not. Okay, so those are the 2 ratios, and then we just have to comment. Okay, so how do we comment? Just remember, the first one we're taking is debt equity. Right, so now we've complied already. We have to mention the debt equity. Now what happened to the debt equity? Now remember, it's a financial indicator. So it's going to be the financial indicator, the trend, which refers to the increase or the decrease, and then you have to supply the figures. Okay, and then later on we'll just have a general comment on that one. Okay, so what happened to the debt equity? If you can remember, I think we had to calculate the debt equity. Just the second part. Okay, so now we're going to need this answer. We're going to need that answer now. Okay, so what was the debt equity last year? So last year, debt equity was 1,1. Okay, last year the debt equity was 1,1, and this year the debt equity is also 1,1. Okay. So the debt equity remained the same, more or less, at 1,1. Okay, so just remember that the debt equity refer to the difference between the relationship between the own capital and the foreign capital. Clearly, if it's 0,1 is to 1, then the own capital is much greater than the foreign capital. So we said earlier, it's a low financial risk, so conditions is favorable for us to go and borrow. Okay, so now we just have to take this information, right? That we have to take to the next activity, which is not the next activity. It is the comment over here. So we're going to mention it. We're going to say the debt equity, right, remain the same for both years at 0,1 is to 1. Remember, I said it's a low financial risk. So it's a low. So now I'm filling in the comment regarding the debt equity. It's a low financial risk. Own capital is greater than foreign capital. Okay. Low financial risk, own capital is greater than foreign capital. Why? Remember, the ratio is non-current liabilities. Non-current liabilities is to ordinary shareholders' equity. So this is only a tenth of that. That's why we have it low financial risk. Own capital is greater than foreign capital, right? It's a favorable condition for us to go and borrow money based on the debt equity alone. Now we have to look at the conditions for the financial indicator, the second one, which is the return on total capital employed. Okay, we just look at that. I think we have to calculate that one also. Yes. Okay, here we are, which is 3.1.3. Here we go. We have to calculate that ratio. It came to 18.8%. Okay. And what was it last year? Last year it was 16.4%. Okay, so it's an increase. And remember, I said we will also compare it with the current interest rate, which is 12.5%. Where do we get the 12.5%? Right, we get the 12.5% from the information given. That's by the non-current liabilities, which is the 12.5% interest that we have to pay the bank because we're borrowing money. Okay. Just remember, so now we have to comment. We're going to mention the 12.5% in the general comment. We're going to mention the trend, and we're going to mention the financial indicator. Okay. So we're going to start with the 18.8%, and we also have to mention the 16.4%, what it was last year. Okay, so when we talk about the debt equity, so now that's the debt equity we have on top. Then we have the general comment for the debt equity at the bottom. Now we're going to talk about the return on total capital employed, just in case we don't know what that stands for. It's return on total capital employed. Right. So what happened to that ratio? It increased from 16.4% in 2013. Right? To 18.8% in 2014. Right? So remember, here I said both years, right? We have to compare to the interest rate, which was 12.5%. Okay? So in both years, the return is greater than the current interest rate of 12.5%. So again, it's a favorable condition to go and borrow money. Okay, so there also it was a favorable condition to go and borrow money. Right? So this comment, when you say return on total capital employed is 18.8%. Which is greater than the interest rate of 12.5% per annum. Okay. So conditions are favorable to borrow money. Okay. So please, when you comment, just remember that you have to supply the figures. So again, I'm looking at the debt equity. That is the ratio that we calculated earlier, right? Its foreign capital is to own capital. Let me just write that here. Right, so here, is our own capital greater than the foreign capital? Then we know conditions is favorable. And the ratio is 1, which is a tenth. Right? So our own capital is 1 and the foreign capital is a tenth, which means we're actually low financial risk. Okay? It's a low financial risk. Because we're mainly using, in most of the case, we're using our own capital instead of the money that we're going to borrow by the bank. Okay, so it's a low financial risk. Then the second ratio that we have to talk about is going to be the return on capital employed. Okay, it's going to increase from 16.4% in 2013 to 18.8%. Right, and we have to compare those two figures with the current interest rate of 12.5%, which they gave us in the balance sheet next to the non-current liability or the mortgage loan. It's greater, right? Our return is greater than the current interest rate, so therefore the conditions is favorable for us to go and borrow money. So again, when we get to the general explanation, it's low financial risk, own capital is greater than foreign capital, right? That refers to the debt equity. That's your debt equity ratio. Then the second one is the return on total capital employed is 18%, which it is currently, right? And that is greater than the interest rate of 12.5%. So conditions are favorable to go and borrow. Okay, so that is why it was a good idea to go and increase. Okay, that was part of the question. So it's actually a good idea to borrow. Why? Because it's favorable conditions. Okay. Right, learners, that was the end of activity number 3. Right. In all these activities, all of them are very similar. All you have to do, you must make sure that you know the financial indicator and you must know how to comment on the financial indicator. It's a very important section of the work. It's definitely coming in. You're going to need it in the future. If you're going to study BCom, you will know the ratios. Okay? It's very important for you to understand where we get the figures, how to substitute, how to get to the final answer. And like we had in the activity, you must know how to comment. Please, it's very important. You never talk about it. You always mention the financial indicator. We don't say it increase. You mention the financial indicator. You mention current ratio, asset test ratio, debtors collection. If it's liquidity, I'm talking about short-term obligations. Okay? If it's solvency, they're talking about long-term obligations or all the that. But it's very important for you to mention the financial indicator when you quote. That is why the examiners, they put the quote 3 relevant financial indicators, mention the financial indicator, give the actual figure ratios or percentages. In this case, it was just figures that you had to give. That was for the ratios. That was for the ratios, and this was for the number of days. And then in 3.3, they spoke about debt equity, so it was again a ratio, right? And then the percentage, which was 18.8%, then you had to mention that. Okay? These ratios are very important. You need to understand them. You need to know how to comment. I hope me working through this will assist you in understanding it a bit better. Right? Make sure you know how to do those ratios for your September exams and for your upcoming final exams, which is in October. Okay? There's just one thing that I want to do. If we have some more time, there we go. Okay. Question 3.4. It says the family owns 740,000 shares in this company. Explain the effect the repurchase or the buyback of shares on the 31st of December had on their control. Give a calculation or 2 calculations to support your answer. Okay. What are they referring to here? Okay. Very important, learners. First of all, it says somebody owns 740,000 shares. So you must go back to your shares. Okay. So if you look at the share register information, here we are. At the beginning, we had 1.2. We issued an extra 300,000, so we came to 1,500,000. Then there was a buyback. That's what they're referring to in the question, and that was the number of shares. Okay, so they want us to work out what was the effect of the buyback in December. So now it's not rand values, but they are talking about the amount of shares. It's the number of shares. How many shares do they own? And the percentages. Okay, so there's 2 calculations. So we can find out what was the story before the repurchase. Before the repurchase. So it's before the repurchase. Okay. Before the repurchase, they owned 740,000 shares of the 1.5 million that was in issue. So we express that as a percentage. Okay. 740 over 1.5 million. They own 740, the 1.5 million. We started with 1.2 million, and then we issued the extra 300,000, so we came to 1.5 million. Okay. So this is before the buyback. So if I calculate that, so it's going to be 740 divided by 1.5 million times it with 100. It's giving me 49.3%. That is before the buyback. So after the buyback, they still own 740,000. But now the number of shares in circulation, or the number of shares that was issued, is no longer 1.5 million. It's now 1.5 million minus the amount that we repurchased. So it's actually 1,450,000. Okay? And we multiply that. Now this is what the question was. They said, explain the effect the repurchase of the shares. In other words, this part. That's the repurchase of the shares. So before we decided to buy back, they owned 43%. Now with the repurchase, now we have to express this as a percentage. It will be 740 divided by 1,450 times that with 100. I get 51.03%. Okay. Now what does this mean now? Before the buyback, they only had 49%. So they were not a majority shareholder because it's either 50% plus 1 share, or it's going to be 50% plus 1 share, or it's going to be 51%, or in this case now, there we can see. So now they own 51%. So now they are the majority shareholder. Okay, that is what that question is all about. Right? Also very important for you to understand how the buyback has an effect on the control of the company, because if they're deciding to buy back, we are decreasing the number of shares that we have in circulation. So now this family, in this case it was the Muller family, because they're owning 740,000 shares, we are not buying back their shares. They want to keep their shares. So you don't have to minus the 90 from there. You have to minus the 90 from the 1.5 million at the bottom, okay, which gave us the 1,450,000. And now they're becoming a majority shareholder because now they will own 51% of the shares that are in issue. Okay. Very important part of the work that you need to understand, Clifford. Okay. Learners, I think that is it for today. I wish you everything of the best for the September exams if you haven't written yet. I hope me working out these activities with you and you following makes it a bit easier for you, and it gives you good preparation for the final exams. Everything of the best for the finals. God bless you. Thank you.